Hi guys, good evening and welcome to Moneycontrol Markets Weekly. I'm Karunya Rao and I'm back with more analysis, more insights and more conversations about the market and the big trends playing out. Joining me in conversation today is Sahil Kapoor of DSP Investment Manager. Sahil, thank you so much for joining us today.
Thank you for having me. Thanks a lot.
It's been a very exciting week for the markets, not necessarily on the upside, but there's been a lot of action. FII selling resumed. Of course, we've been witnessing that trend for some time. Rupee kept falling to fresh records day after day. You had the RBI MPC meet outcome as well, wherein we saw 50 bips rate hike, largely on the expected lines. And of course, today there was a mild recovery in the rupee as well, which saw the markets rebound a tad. But how should an investor, especially a retail investor, make sense of all that is playing out, not only macro wise, but also in the micros when you look at the market? Why are we witnessing so much volatility and so much of inconsistency in the pattern?
Sure. So one thing is that there are winds of change blowing, and I think that is one of the major reasons why the market is so volatile. The market wants to see a pivot where the central banks change their stance from being hawkish to more neutral, but most central banks have not done that. And inflation readings, whatever readings that we get, they have come off a little bit from the highs, but they are still too high. So if you even listen to what RBI governor said today, he said that inflation continues to be persistently high. And similarly, other central banks have been saying similar things. But when you look at the market indicators, when you look at things which cause inflation or lead inflation levels like commodity prices, for example, housing and rentals in US, all those indicators have already turned or started to turn. And the anticipation is that once these indicators turn, inflation will also fall in the next maybe a couple of months or 6 months. And that trend will cause the central banks to change their stance. So I think there is
Hmm.
this tug of war where the expectation is not meeting the reality, and because of that, the market is very choppy. And second reason, so to speak, is that equity valuations were quite high. When we started 2022, they were very very high, and because interest rates have gone up, the PE multiples have shrunk. For example, this year Nifty PE multiple has shrunk by around 200 250 basis points from beginning of the year to now, and similar
Hmm.
multiple has shrunk globally also. So I think this tug of war between rising interest rates and falling valuations is continuing. And then you can put earnings growth of various countries together to make a trend
Hmm.
on which countries are doing better than others.
Right. But if we look at the way markets have behaved, equity markets, we've done better relatively so far. As far as the US benchmark Dow Jones is concerned, till date, we continue to do so despite whatever volatility and consolidation phases that we witnessed. But the big question that people keep asking is, what is going to be the end game for the markets? Is it correct to catch a falling knife, or do you see it more like an opportunity to go bottom fishing and bargain hunting?
Sure. So I think we have to look at it from two angles. One is that when we began 2022, we had an assessment in mind that this could be year of consolidation. As I said, earnings catching up, economy improving, and earnings multiple coming down. So eventually you do a round robin move, but you don't move anywhere. You don't go anywhere. I think that's what's happening right now in 2022. How to approach this market? One, right now, I don't think we are in a falling knife kind of a scenario when it comes to the
Hmm.
Indian market. Of course, there are many other markets who behaved much more badly in terms of the corrections,
Yeah.
where I think you pointed out. But domestically, I think we've been much better. As you said, we've been outperforming the other markets. So how I look at it is you go and look at valuation multiples. So according to the street estimates, Nifty closed the FY 22 somewhere around 800 rupees of earnings, and the expectation is that by FY 23 end, we'll get closer to about 860 or so, and by FY
Hmm.
24 we'll possibly get closer to between 960 to 1000 rupees. So I think most important number to watch out is when will Nifty touch 1000 rupees in EPS. Will that happen in
Hmm.
March 24 or let's say December 24? We don't know, but it's quite possible that that is the time frame. And if you keep that time frame in mind, let's say between March 24, 2024 and December 2024, if Nifty EPS is going to hit the 1,000 level at that point in time, that means if you trade below 17,000 in the basket of 16 and a half to 17,000, at 18-month forward multiple, you are trading at 16 and a half to 17 times, which is the historical average multiple. And I think that is the place where you place your bets and say that I'm going to increase my equity exposure whenever I touch this range or I go below this range. And that is the
Hmm.
philosophy that we've articulated to many of our investors. I think that is the way to go. If you see these kind of opportunities because of whatever events which unfold, you should implement increasing your equity allocation, going forward.
Right. Okay. But you were talking about, a range. This is how we also in the recent past have been largely range bound. There's been like that 500-600 point range where the markets have been gyrating. Is a range bound market or a range bound Nifty or a Sensex scary for investors?
So I don't think that it's a scary proposition. See, how I approach it is that if you look, let's say one level below, if you go to sectoral indices, there has been a huge amount of move, right? From I think from about March onwards, the NSE Auto Index is up about 40%. I think from the same time period, the Bank Nifty moved higher by around 22 to 25%, and now then it corrected later on.
Hmm.
IT index actually went down. So there has been enough and plenty of moves, both for traders and investors to capture, and many of these trends were in the offering. There was data highlighting that these moves are likely to play out. Even in the present, if we see, I think there are sectors and there are clear opportunities which showcase that in the next 6 months to 1 year, which is a shorter term time frame, there are going to be a lot of opportunities even on the long side. Even let's assume that even in the next 1 year, if Nifty doesn't do much, if it doesn't give you great returns, there are still, I think, sectoral plays which are possibly going to give you excellent investment opportunities. So I will not be bogged down by what happens with Nifty, because I think there is a lot more opportunity when you go to sectors and themes, and that
Hmm.
is how you should capture. But the base case remains, if you get cheaper because of whatever events which are happening globally or domestically, Nifty will deliver return to you. The numbers that I told you earlier, let's say if we do actually do 1,000 rupees EPS for Nifty in 2024, on a trailing basis, Nifty trades at 20 times. That means somewhere in 2024, we are going to hit 20,000 on Nifty based on these numbers. If that is true,
Hmm.
then any level closer to 16,500 gives you a 12% kind of a CAGR on Nifty itself, which I think
Right.
is an attractive proposition.
Right. I would love to hear more about the themes and sectors, but let's first talk about the larger market picture that presents itself right now, that's playing out right now. Would it be suffice or would it be correct to say that those who missed out the rally in March 2020 onwards, right
Yeah.
now, the upheavals and the volatility we're seeing in the market, does it present an opportunity for people who missed out that bus back in 2020?
Sure. I think it's a question which I've been thinking in my mind. So I've been thinking on similar lines on, what could be a good opportunity post
Hmm.
such a mega rally which took place in 2021. I think this correction represents that. In fact, even in one of my internal chats with one of my colleagues, I mentioned the same point that this correction is a good opportunity. And even when the Russia-Ukraine war broke out in the initial part of the year, I said that this could present a good investment opportunity going ahead because markets are going to get nervous,
Yeah.
and that's what has happened. If we step back and see what has happened with earnings, I think earnings continue to remain strong. So I'll give you one data point which is very interesting. If you go back and see Nifty earnings from FY14 to FY19, Nifty earnings EPS growth was only 1.5% CAGR, CAGR. And if you remove BFSI, which is the largest component as a percentage of market cap and as a weightage of Nifty, the growth was around 8%, right? Right now, banking has come back. They have started to report good profitability numbers. Other sectors are doing better than they were doing in that phase. So expecting a 12% kind of earnings growth, I think, is the base case. And if that is true, I think this, as you said, represents a good opportunity. I'm not saying that this is the most important opportunity that has occurred in last 10 years. I think it's a very decent opportunity. It represents an entry point for people who haven't gotten earlier, and in a very, very structured and disciplined manner, maybe through SIP or structurally adding equity exposure on each decline. I think this should be utilized.
Okay, so now I want to come to the part where you talk to us about where to invest, the themes, the trends, or the mega trends that one should chase right now. What's available at attractive, tasty valuations?
Sure. So once you say attractive valuations, I think the most attractive part is the healthcare segment. So
Okay.
we did an analysis. We looked at about 100 stocks, 96, 97 stocks, and we did an analysis. Looked at the historical data. 68% of all these stocks were trading in the bottom 30 percentile of their valuation. So this is if you do a pecking order in terms of which sectors offer a good value. I think healthcare sits at the top, where I think the
Hmm.
opportunity is much stronger than any other place. Secondly, as a thematic theme as a whole, from a directional point of view, we are playing more domestic, locally linked structural stories. We think that trends are much more stronger there, stories or sectors where you are seeing top line growth and possibly a reversal in margins is what is going to play out. So, what are these sectors? These are like consumption sectors like automobiles, auto ancillary, uh, domestic BFSI, which is banking and financial services, domestic consumption linked sectors, both white goods and brown goods. I think they are going to do quite well. And third, possibly a very small export oriented play could come in because of the freight rates. I think many companies which sell overseas, they have been hit very badly because of freight rates. That story will also play out. So, in a nutshell, domestically linked oriented sectors because of two reasons. One, they are enjoying stronger earning growth. Second, their margins were really hit when commodity prices went up. Uh,
Hmm.
Commodity prices have already come down, they are going down even further. And because of that, that margin hit is now reversing. They have already passed on the price hikes. Now they are able to maintain their margins. I think from Q4 onwards, you will see profitability returning. So these are the themes which possibly appeal to me right now. And I think in the next 1 to 3 years, they should do well. And one small word, even for the banking and financial services industry, specifically the lending part, there are three very clear three positives. One, overall India's credit impulse. I'm going to put some data out in the next few days. Is rising at the fastest pace in last 10 years. We haven't seen that. Uh, for example, the credit growth is at 16.5%. Our NPS ratio has fallen to a 5 7 year low right now. It used to be at 12 13% in FY18. We are hitting 4 or lower right now. And third is banks have healthy balance sheets, right? They have capacity to lend. So lenders, again, a theme which should do well in the next 2 to 3 years.
Any complete avoids right now, big red flags that you see in any sector or basket in the market?
So I would probably put a void on metals and oil and gas because of two reasons. I think one is that there is a lot of volatility there. There could be opportunities in this sector, of course, but I think that opportunity will be most likely towards coal and other stuff, maybe towards fertilizer rather than having these kind of stories. So commodity plays available in other niche sectors, but an avoid on metals and oil and gas because of two reasons. One, largely their business cycles are driven by commodity prices, and the
Hmm.
uncertainty persists for commodity prices. Uh, our analysis show that they are probably going to correct more or remain muted, either of the two. And secondly, these companies are not available at cheap valuations, right? They may appear cheap on the face of it because their earnings have gone up significantly, but from a cyclical perspective, I think right now we can avoid them.
What about IT? Because IT, on one hand, there is some near-term benefit which could happen because of the rupee depreciation. But on the other hand, you have some very fairly serious concerns about the economic growth in bigger markets like the US, the UK, which are the key markets for IT giants. So,
Right.
how do you think IT sector is placed right now, not just for the near term, but also maybe for another year, 2 years, or beyond? right now, because they have cooled off a bit, should one buy? Is it attractive or a good opportunity to buy at a current level, or should one wait to see what exactly and how exactly things play out on global macros?
So, quite frankly, it's a question for which we also don't have a clear answer. And I'll tell you why. First is, as you said, the valuations are not so attractive, right? They are not so attractive that we say that we are going to have that margin of safety and we can play them. And secondly, we feel that it's a sector which is the only sector. I'll give you a data point. In the last 15 years, the only sector globally, not only in India, globally, which has shown a CAGR growth in earnings of more than 15% is tech and information tech. Anything which sells software, services, or hardware that has done very well. So technology as a sector has done well. There is no reason to believe that the long-term trend has broken. It continues to remain strong, or maybe because of COVID, it has even strengthened a bit. The problem with the sector right now is the valuations, and uh, and we've been grappling internally. I've been thinking about it. Is there a case for valuations to be slightly higher than they were pre-COVID levels? And there are reasons to believe that could happen. But from a margin of safety perspective, my best guess is that in the next 2 quarters, IT might undergo more consolidation. And right now, we are a little underweight, trying to look for opportunities where we can go equal weight. So right now we are in the wait and watch mode, or probably you could say a little bit of confusion. And more data, more earnings reports will probably remove that confusion, and we'll look at IT more closely. Right now, we are a
Hmm.
little away from it and waiting for it.
Okay, all right. Uh, right now, if you know, we're also at the onset of the festival season. A lot of people look at times like this to invest, not only in equities but also in commodities like gold. And right now, with the rising interest rate regime, perhaps a lot of people out there are also planning to move some amount of their corpus to fixed deposits as well. So
Right.
if one is looking to restructure their portfolio or sort of take a relook at host of investments, how can they look go about it, and what do you think should be in a market like this a good ideal sort of a way to invest in terms of holdings across different assets?
Sure. So I think first, as you mentioned, people are looking to invest in fixed income in gold. I think in fixed income right now the time is good if you want to lock in a 5 year kind of a investment product. Looking at debt passives which have a maturity beyond 28 years, I think offers a very good profile. And I think that is something that you can look forward to. The yields are attractive. We have seen yields come up a bit. So at least a part
Hmm.
of your fixed income investment can flow to that place. Secondly, gold. Gold hasn't done well in the recent past. Even in the last 1 year, no
Hmm.
price movement has happened. But what's beautiful to look at is in the last 3 months, when rupee depreciated, gold prices in India were much more stable than global gold prices, largely because of the currency conversion, right? So gold as a hedge for various uncertainties continues to remain a very, very strong asset class. So I think that play continues to be there. And over the next few years, there is a good possibility that gold could actually perform much better than what it has done in the last 2 years. So these two asset class should remain good in the good mix of your portfolio. They should form an important part of your portfolio. And as always say that debt is like a seat belt. It offers you a lot of safety in uncertain times. So you need to have exposure to debt investments to protect your portfolio.
Okay, but would you like to flag off what percentage in which asset class, or is
So
it
I'll tell
is
you
it
that yes, right now I think for an individual who is a little aggressive in nature, who can take some risk, his portfolio's 70% portion should be in equity. I think that is something which is ideal right now, and possibly
Hmm.
around 20 to 25% in debt, and rest about 5% should be in gold. I think that is the ideal mix of how you should look at, and then you can of course look at the 70% of your equity portfolio and break it down further into what kind of themes you want to play, what kind of funds offer the sectors that you want to play. As I said, you should be overweight on lenders and banking and auto and pharma. Are there funds out there who can give you that kind of exposure? Once you marry that, I think your good, strong exposure will be complete.
Sahil, before we wrap up the conversation, want to ask you if there's any one big lesson or a takeaway that you've learned from previous, cycles like this when interest rates have been so aggressively hiked, or even any other unprecedented scenario, not just COVID, not just interest rate hikes, but even a geopolitical conflict that's playing
Yeah.
out. What is the one big takeaway or one big learning to have from events like this when you're invested in the market?
So the biggest learning is that the world moves on. It doesn't end, and a lot of people will see and talk about a judgment day in the market that everything is going to collapse, etc., etc. I haven't seen that since the time I've joined the financial industry. Maybe not every week, but every few months, I've heard these different predictions of things coming to a standstill or markets undergoing a correction that they will never recover from. But these things don't occur, right? Market moves in cycles. Any large event is also cyclical in nature. Anything which creates a bear market puts or sows the seed of the next bull market. So these are all cycles. So when there is a crisis, that is the most important opportunity for people who are prepared to benefit from it. So just to give you a point, I wrote an article called which was on how do you light an emergency fire for yourself, right? I think that is something which is very very important. You create opportunities for yourself when you are doing good. When there is a bull
Hmm.
market, you create opportunity when there will be a bear market, and you can benefit from it. So largely, the only lesson is that world moves on, and you will also move on. Your portfolio will also do well if you are prepared.
Very well said. And on that note, we will conclude today's conversation. Sahil, great to have you on board as always and getting your insights and your observations of market and the big trends playing out. Thank you for joining in. And guys, thank you so much for watching.
Thank thank you. Thanks a lot.